Chapter 12 will be discussing compensation. Specifically, we're going to discuss and explain the tax implications of compensation in the form of salary and wages from the employees' and employers' perspectives. We're not going to do Learning Objective 2, but we will be doing Learning Objective 3, compare and contrast taxable and non-taxable fringe benefits that were introduced in Chapter 5, and explain the employee and employer tax consequences associated with those fringe benefits. So we're going to go through all of them again in detail. So let's start off with salaries and wages. Employee considerations for salary and wages are the fixed amount of compensation for the current year, no matter how many hours are worked. Salaried employees eligible for bonuses, so bonuses are included. Employees receiving wages generally get paid by the hour. Salary, bonus, and wages are all taxed as ordinary income, and they are reported on line 7 of the 1040. Generally, it's the cash you receive during the year, unless you could have constructively received it and you chose not to. That's what will be included in your salaries and wages. Employees complete a Form W-4 when they are first hired to supply the information to the firm so that they can withhold the correct amount of federal income tax. So on this W-4 form, it indicates whether to withhold at a W-2 summarizes an employee's taxable salaries and wages. It's given to an employee and also sent to Social Security Administration, a copy of which is provided to the IRS. It provides annual federal and state withholding information. This is what a tax preparer uses to report the wages on the Form W on the 1040 line 7. The Form W-4 again supplies an employee's information. It's generated by the employee and it remains constant unless an employee makes changes. So for instance, I got married in May of 2017. So when I got married, I had the opportunity, I had a life change, to change my W-4 form, and I did at my employers to reflect I was now married, so I wanted less income tax taken out. So the employer is not controlling how much money you have taken out of your or the taxpayer's paycheck. You are. And you just file a new W-4 when you want that amount changed. On the employer side, so that's the employee side. On the employer side, they get to deduct salary and wages on their tax return that they pay. So employers computing taxable income under the cash method generally deduct salary and wages when they pay them. Those that do the accrual method deduct wages payable as well. Compensation expense that's accrued at the end of the year is deductible in the year accrued. So if you expense it before you pay it, that's an accrual. You can deduct it in the current year even though it's not paid if it's paid to an unrelated party, so an employee, and it's paid within 2.5 months of year end. If it doesn't meet those conditions, it's not going to be deductible. Now, compensation expense can be accrued at the end of year and deductible when it's paid to a related party and that related party owns more than 50% of the employer corporation. So now we're talking about a shareholder. After-tax cost of providing this salary is generally much less than the before tax, as the employer deducts salary and associated FICA taxes paid. So if we're trying to determine what's the after-tax cost of giving someone a salary, well, remember, for purposes of federal taxes, when we give someone a salary as an employer, we're paying them gross pay. Part of their gross pay goes directly to the employee. Part of it goes to pay taxes and voluntary deductions and things like that. It still costs the employer, though, the gross pay. If you take that and add to it the FICA match, remember, employers have to pay the FICA tax as well. Okay, those two amounts added together are deductible. So you take the deductible expenditure, the salary and the FICA, and if you multiply that by 1 minus the tax rate of the employer, the marginal tax rate, so the tax rate for $1 more of income, that much is how much it actually cost the employer to provide that salary. Now think about it. I'm going to do a little computation. You could grab a scratch paper. Assume the deductible expenditure. So what that means is that the employee's salary plus FICA tax. So how much the employer can deduct on their tax return for paying that employee, the deductible expenditure is $100,000. So the employer gets to deduct on their tax return, even though they paid out $100,000, they get to deduct that on their tax return. So they're going to have a tax savings from that payment. How much? Well, let's say their marginal tax rate is 30%. If you multiply 100,000 times 30%, that's $30,000. So they don't have to pay $30,000 because they have that $100,000 expenditure. So how much is the after-tax cost of really providing that salary? Well, they had to pay out $100,000, but they saved $30,000 on taxes, so subtract it. So the actual cost, the after-tax cost, is the difference, or $70,000. Now, if you use that formula there, they take those two steps I just did and combine them into one. 100,000 times 1 minus the marginal tax rate, 1 minus 30% will give you 70%. So the actual cost of the salary is only $70,000. And here it is again. They paid one of its employees $80,000. They're in the 35% tax bracket. What is the after-tax cost? Bullet point means. Fringe benefits. Employees, this is what we talked about before in Chapter 5. Employers often provide non-cash benefits to employees in addition to their cash compensation. And they range from all different kind of things. Health insurance to the use of corporate aircraft. Normally, they're taxable to the employee on receipt. That's the general rule, because Code Section 61 says include everything unless it's specifically included. And right in Code Section, it says compensation for services, including fees, commissions, fringe benefits, and similar items. So we don't look and go, oh, it's a fringe benefit, it's non-taxable. That's not true. Employees recognize compensation income on all benefits received unless specifically excluded. That's what I just said, right? Treat benefits received like taxable compensation, cash compensation. And the employer deducts costs and pays employee share of FICA taxes on benefit. We've talked about that. So, what are the employee considerations? Employees may prefer a taxable benefit to an equivalent amount of cash when they benefit from employer provided quantity or group discounts associated with the benefit. Employees must recognize a certain amount of gross income when employers pay life insurance premiums for the employee for policies with a death benefit in excess of $50,000. This is group term life insurance. A lot of employers offer it, and a life insurance policy on the employee. If your life insurance policy is $50,000 or less, so at death the payment would be $50,000 or less, there's no taxable compensation to the employee. All premiums are tax exempt that the employer pays related to that um, um, related to that policy. Sorry. What what triggers or makes premiums taxable is when the amount is higher than $50,000. For instance, you have a $70,000 life insurance policy at work. Premiums related to the first $50,000 of it are tax exempt. You don't get taxed on them. Your employer pays them, they deduct them on their tax return. They're not included as income on your tax return. But once your death benefit goes above $50,000, the premiums related to the amount above $50,000 are taxable. And here's how we compute it. We subtract $50,000 from the death benefit. So if it's the $70,000 we just talked about, $70,000 minus 50, and that's $20,000. So the premiums related to $20,000. Divide divide step 1, the $20,000 by 1,000, we get 20. Multiply the result from step 2 by the cost per $1,000 of protection for 1 month from the table provided in the Treasury regulations based on the age. So we would need that table. Okay, so we would go into the Treasury regulations and find that. And that would give us our monthly cost. Then we multiply that by 12, and that's how much of the premium would be included in the employee's income. And normally the employer adds it in on the W-2, but it is taxable, and we want to be aware of that. So there is the table. Oh, God, it's here. So if you are between 35 and 39, you would take 20 times 0.09. That's $1.80 times 12. So it's not a huge dollar amount, but it is taxable. $1.80 times 12. I'm doing it old school here, so I'm hoping I'm doing it right. So taxable would be $21.60, but it is taxed. Okay. The employer consideration, they treat taxable fringe benefits just like cash compensation. So when there's any fringe benefits, they're normally allowed to deduct them on the tax return. So it deducts its cost of the benefit, not the value. So whatever they're paying for the benefit. That's what that slide's talking about. We're not too concerned about that. We're more about the employee side. Also, no additional cost services, qualified employee discounts, working condition fringe benefits, de minimis fringe benefits, qualified transportation fringe benefit, qualified moving expense reimbursements, and then the way the plans are prepared. Okay, so this is that list very similar to what we looked at in Chapter 5. We're going to take a look at it again. So group term life insurance. We've talked about this already. Let's go through it one more time. Employer paid premiums are non-taxable up to the first $50,000 of group term life insurance. Any premiums related to amount of coverage above $50,000 will be included in the employee's income in that year. Health benefits, and they give us the code section there. Code section 105 to 106 is where they define the non-taxable health benefit. Employer paid premiums on health, medical, dental, and eye insurance. And the benefits provided through these insurance, as long as they meet a medical definition in the tax law, which normally they do, are non-taxable. So the actual payment of the premium by the employer is non-taxable to the employee, and the actual benefit you receive when you go to the doctors, the hospital, things like that, all non-taxable. Meals or lodging for the convenience of the employer. This is code section 119. This is on in chapter 12, a specific section. I'm looking at page 12-25. It may be a little bit different in your book. So we've got to make sure we understand this. The value of meals provided at the employer's business premise, not they went out and got takeout. So they're actually making the meals at the premises for the convenience of the employer, would be non-taxable to the employee. So if it's a nurse working in a hospital and they go downstairs to the cafeteria and have a free lunch, that is what we're talking about here. It's at the employer's place of business, and it's for the convenience of the employer, so she's still on call. Same with a restaurant and a waitress. So it's very specific here. The employer getting pizza takeout so you can continue working is not what we're talking about here. Lodging, even more specific. The lodging must be a requirement of employment, and it's provided by the employer. So a forest ranger who has to stay in a cabin in the woods as part of his job requirement, that's non-taxable. Anything else really? So when we're looking at it, we really got to make sure, is it for the convenience of the employer and a condition of employment? If not, it's a taxable item. So that income related, the value of those lodgings, the values of those meals would be included in the employee's W-2 or on their tax return if it's not on their W-2. Employee educational assistance. This is in code section 127. And it says employers can pay or reimburse employees for tuition, books, and fees up to $5,250 in a year. So that's per year, tax-free. Now, it doesn't mean that they can't reimburse them more. The tax-free portion, $5,250. Dependent care benefits. Employers can pay up to $5,000 in dependent care expenses for an employee. It's very specific. This cost is for providing care for a dependent, so the taxpayer's dependent who is under 13 years old, or a dependent who is disabled. Okay, so but up to $5,000 of employer-provided assistance for dependent care, non-taxable, and that's in code section 129. No additional cost services. This is in code section 132. Benefits that don't cost the employer a lot of money. You use the photocopier once in a while for personal reasons. You fax once in a while. Okay, this is what we're talking about here. Very small amounts, they're not worth tracking and aren't don't add up to a huge amount. So they're non-taxed. Qualified employee discounts. Reduced prices on employers' project products within certain limits. Now, the taxable portion of an employee discount is the part of the discount for services that is above 20%. Okay, let me see on the desktop. Okay, so we're talking services there. What if it's an employee discount on a product, though? A product. So let's say, let's go back to the services. You work at a travel agent, and the travel agency gives you a 15% discount on all your travel you book through them. Well, So we do tax planning for fringe benefits. Employer proposed to reimburse employee $200 a month for his parking costs. What amount of this reimbursement would be non-taxable qualified transportation fringe benefits? Well, all of it, because then they can exclude it. So when we are looking at fringe benefits packages, we've got to keep these non-taxable and taxable events in mind. And there are publications out there that give total guidance to employers on fringe benefits. Now, if you're sitting there going, well, I'm going to be doing employees' tax returns, you never know. You might be on the employer side trying to decide, is this fringe benefit taxable or not? Both taxable and non-taxable fringe benefits can make up a significant portion of an employee's compensation. These are taxable unless the tax law specifically excludes them. You got to keep that in mind. Taxable fringe benefits usually represent a luxury perk, so it's something above and beyond, while non-taxables are generally excluded for public policy reasons like health care coverage. Okay, so this table in your book is awesome to keep you get that big picture of all these different types. Okay, this was an example from a prior PowerPoint, I believe, and also yeah, there's an example throughout the chapter talking about Julie and what kind of non-taxable benefits she has. So that was the overall answer for her non-taxable and taxable. And you could see the total value of what she's getting and how much her employer is actually paying beyond her salary. So that is a great example to go through in your book and make sure you really grasp what these fringe benefits, taxable and non-taxable, mean. So please post any kind of questions you may have about the compensation chapter to learn.